Hello, it's Jeffrey Christian. It's not quite 11 o'clock in the morning here in New York on Tuesday, the 12th of August. I want to talk about the markets. We've had some major moves since our video on Friday. Also, I want to go back over silver surpluses and the mythical deficits and some of the magical thinking that people have to try to convince themselves that the world's running out of silver when it's not. We came out with US CPI today for July. I'll talk a little bit about that. The gold price this morning was around $3,385 for the December contract here in New York at 10:50 in the morning. At the same time, in London, it was about $3,334. So there's about a $61 premium in New York still. If you go back to last Friday, the price of gold has spiked up to $3,534 here in New York. It was trading around $3,482 when we recorded at 9:15 in the morning. And that was about $100 or $90 premium over the London market. That represented people being willing to buy extra, pay extra in New York because of concerns about a gold tariff that someone in the Trump administration had talked about. Between last Friday and yesterday, the Trump administration waffled on that, said there wouldn't be a tariff on gold bars, and the price in New York came down. 10:50 this morning, just a few minutes ago, the price was $3,385. That was about, as I said, $51 more than in London. There still is a premium in New York because people are not sure. The administration is waffling back and forth on all sorts of things. So there still is some concern that there could be tariffs and other impediments to getting gold supply in New York. Plus, the demand for gold has been stronger in North America so far this year than it has been in Europe. So there is greater demand here, applying some pressure. But probably those two things combined don't warrant a $51 premium. Our expectation is that the gold price will continue to consolidate. Probably, we did see a spike down to about $3,260 some odd dollars a week or two ago. We think that $3,300 or maybe $3,260 is a temporary support level, and that the price will consolidate above that before moving higher later in the year. The economic, political, and social problems in the United States and in other countries and on a global international basis continue to be there. They're not being resolved. If anything, they're getting worse. And that's likely to continue to stimulate investment demand for gold and silver, keeping the prices higher and moving them even higher than they are today over the course of the next, say, 15 months or so, maybe longer. Silver prices have risen too. Last week they had gotten up almost to $39. They've come back off. They're about $37.69 this morning in New York. Our expectation is that the price will find support, above $35, $36 an ounce and move higher over the course of the rest of this year into 2026 and possibly through 2026. I'm going to talk more about silver in a bit. Platinum prices have continued to come down. They're about $1,339 right now, down from $1,504 a couple weeks ago. Our expectation is that they'll continue to come back to that trading range of, $900 to $1,100 or maybe $1,200 that we've seen over the last 11 years. Prices were spiked up by speculative buying and inventory buying predicated on statements that the platinum market is in a deficit. It is not. The platinum market is well supplied. There were statements that there was a big increase in platinum imports into China. Platinum imports in the first 7 months of this year are actually down year over year in China. What we have seen is some platinum imports in April and May that largely went into Shanghai and industry inventories and also the inventories of jewelers. So we think that the price was unduly stimulated on false hopes of higher prices by speculators that drove the price higher. Our expectation is the price will come back off as economic weakness in the auto industry continues to spread and become more apparent to a broader market. Palladium prices also spiked up. They got to about 1,360. They've come back down. They're $1,137 today. And that is pretty much back into that range that we've seen of $850 to $1,150. So we're seeing palladium prices normalize. Now, before I go into silver and some of the myths and magical thinking that's going on there, I want to talk about the difference between capital assets and current accounts, because clearly from some of the comments, not only related to gold and silver, but also related to the U.S. government and its debt and deficits, there seems to be a lot of people who don't understand the difference between assets on your balance sheet and current account revenue and expenses. There's a big difference, and knowing the difference is critical to understanding what you're seeing. I'll give you two examples. The first one is refined silver inventories. They are not current supply. Refined silver inventories, I'll show you some charts later in this presentation. Refined silver inventories are capital. That's stuff that people, mostly investors, but also maybe 1 billion ounces held by banks and trading companies, that's their capital. It's on their balance sheet, and they mark it to market if they're smart. It just sits there, right? Current account is the buying and selling. In so far as inventories don't get sold, they are not current new supply. Even if they do get sold, they're not current newly refined supply. That's what CPM Group measures. We always talk about total supply of newly refined silver from mine production sources and from secondary recovery. We've done that for 60 years now. That's the way we look at current new supply. It doesn't include inventories. And then we measure that against fabrication demand. Inventories are capital stock. Same is true with the U.S. Treasury. And you're hearing a bunch of nonsense right now about, well, the U.S. Treasury could revalue its gold from the $42 that it uses for its book entry, and they could solve their debt and deficit problems. They can't do that merely by revaluing the gold. You have to mobilize the gold to affect either your deficit, which is a current account balance, and your debt, which is your capital balance. You can say, as some of these people are talking about, oh, we're going to revalue our gold to the market. That's fine. At $3,400 an ounce, the 261 million ounces that the U.S. Treasury owns is about $887 billion worth of gold. That does not allow you to pay off the $39 trillion the Treasury owes. Yeah, nor does it actually reduce the deficit unless you sell it, right? Capital stock, you can do it. People say, oh, well, they're going to raise it to 10,000. Or if they raise it to 150,000, the value of the gold is now on the books at the Treasury is now greater than the $38 trillion. So they don't have a net debt. No, they do have a net debt. They have a paper accounting that they've revalued their gold at unrealistic, at prices that are unrelated to the market. But that doesn't do anything to pay down the debt or to make them more creditworthy or to reduce the deficits. In order to pay down the debt or to reduce the deficits, you have to sell some of that gold. And you're not going to sell it at $10,000 an ounce. And no one's going to buy gold from you at $10,000 an ounce. They're going to say, wait, why would I pay you $10,000 an ounce when the price is $3,335 right now, right? And if you hold 261 million ounces, which is equivalent to more than 2.5 years worth of newly refined gold entering the market, The price of gold is not going to rise to $10,000. It's going to fall from $3,350. So I'm not going to pay you $10,000 for your gold. Ergo, your book entry on your balance sheet that your gold's worth $10,000 an ounce is your pipe dream. It's meaningless to the market. It's meaningless to everyone else. People say, well, isn't revaluing the gold like that the same as what they did in 1933 under FDR? No. In 1933, we were on a dollar gold standard. In the beginning of the year, the gold price was set at $20.79. And the Treasury was there buying and selling at $20.79 every day. And that's why that price was a real price, and it was the market price. If you had gold, you could sell it to the U.S. Treasury at $20.79. If you wanted gold, you could buy it. When they revalued it to $35, the next day, you could go in and say, oh, I want to buy some gold at $35 an ounce. And they would sell it to you at $35 an ounce. Or you say, I have some gold, I want to sell it to you, and I want $35 an ounce for it. And they would buy that gold for you at $35 an ounce. There were transactions that supported the value, the price that they used to value their gold inventories. Today, the Treasury doesn't buy and sell gold. It doesn't do it at $42 an ounce. It doesn't do it at $3,300 an ounce. And it isn't going to do it at $10,000 or $150,000 an ounce. You got to understand the difference between a balance sheet with capital assets on it and a current account balance, which is revenue less expenses. It's very important, and it's amazing the number of gold and silver experts on YouTube that don't seem to understand that. Now, one of the things that we've noticed recently is all of a sudden people are saying, oh, it's not a deficit, it's a mining deficit. All of a sudden they're using the term mining deficit. See, people who insist there's a shortage of silver, but they keep getting confronted with evidence and information that says, no, there's no deficit. They change their definition. They're not talking about a deficit in the market anymore. They're talking about a mining deficit. So they can continue to believe that there's a shortage. Here are some comments from recent CPM videos. There's absolutely 100% mining deficit. Jeffrey, you're confusing deficits and shortages. There's a year-over-year deficit in the mining industry. Yes, there is. I'll show you in a second. But it's not what you think it is. And I've never heard of any of this mentioned, blah, blah, blah. They're talking about mining production deficits. No, they're not. So why are they doing that? Because they have to find a reason to believe. This is a chart that shows fabrication demand, the red line, and mine production back to 1960. We actually have the data back to 1950, at least. But this chart goes to 1960. And you can see that mine production has been less than fabrication demand. Forget investment demand, because investment demand should not be used in this balance. Investors don't use or consume silver. They buy silver and they hold it in refined silver form. You want to know if somebody's using it or consuming it. Most silver is used and not consumed because you can recycle it. You want to know if somebody's using it or consuming it. And you can see here that since 1960, actually it goes back to 1950, almost every year mine production has been in a deficit, has fallen short of fabrication demand. So yes, there is a mining deficit, and yes, it is inconsequential to the price of silver by and large. Except pay attention to this. Notice that the biggest period of the deficit of mine production relative to fabrication demand is 1988 through 2008. That includes the period from 1990 to 2005 when investors were selling more than 1.5 billion ounces of silver. And the price of silver went from $8 an ounce in 1987-88 to $3.50 in a few years, and it traded between $3.50 and $5.50 for 15 years. So there is a relationship between fabrication demand and mine production. When you see that mining deficit grow, the silver price should be falling. It's not a bullish thing to have a mining deficit, and it hasn't been for the last 75 years. So why are people doing that? See, when a true believer is confronted by irrefutable facts and realities that are so overwhelming that the true believer cannot dispute them, in order to continue to have faith in that which he believes, he has to change the metric, the parameter, the text. So instead of talking about deficits in the market, it's a mining deficit. Okay, now I can feel more comfortable that I've been right all along. There's a deficit. It's a mining deficit. It's not a real deficit, right? It's just inconsequential. And looking at mining, you're ignoring the 25% of supply that comes from recycling, which I'll go through in a second. So if you look at the silver market as total newly refined silver, less fabrication demand, we've been in a surplus since 2006. We did have a 15-year deficit from 1990 through 2005, and the silver price was flatlining around $4.50, $5.50 for most of that time, as you can see from the red line here. That's the proper way to look at it. There is no silver deficit, only marketing hype. Only marketing hype. Another way to look at it is that chart again, but this is total supply, total newly refined supply. It does not include inventories, despite what some wags have said. We don't include inventories in our estimates of total newly refined supply coming into the market that's refined from mine production and secondary recovery. If you add that secondary recovery to your mine production, in that table I used earlier, that line where mine production is way down here, take a look at it with secondary supply, and all of a sudden, yes, you have a deficit. Again, that deficit is from 1990 to 2005, a period of low, stagnant silver prices. Since 2006, you've had a surplus, and the silver price has been rising. Right? That's the proper way to look at the market. Real deficits, real surpluses. And for those empty minds that say CPM Group never projects or estimates a deficit, we projected that and estimated it accurately starting in the late 1980s. Late 1980s, we were saying there's going to be an extended period of deficit because we were looking at the fundamentals as they were evolving: mine production, secondary recovery, investors selling silver out of disenchantment. And we said there's going to be an extended period of time where there's a deficit in the market and the silver price is going to flatline. At some point that will end and the price will rise. And 15 years later, in 2005, 2006, we were right. But we do project and estimate deficits, despite what some people who don't know shit about us say. Excuse my language. So here's our estimates of total supply of newly refined metal. The dark blue is mine production. The gray or lighter blue is secondary supply. And Todd's right. This factor that you have to pay attention to is recycling. So how important is recycling? As I said, it's about 25%. We had about 250 million ounces of silver refined from scrap last year, and it's probably going to be about 275 million ounces this year. And you can see it's been more than 200 million ounces a year since the late 1990s, since 1999, 1998. Secondary supply is incredibly important. And if you're going to try to justify being bullish by saying there's a mining surplus, you're forgetting about secondary recovery. This is another way to look at it. The red line is total newly refined silver supply entering the market every year. And the blue line is secondary recovery. Now you'll see this big spike in total supply in the late 60s. That was silver being sold by the U.S. Treasury or being made into coins, which went into circulation and were promptly taken out of circulation by silver investors. Then you see a little bit smaller spike in total supply in 1979, 1980, and a bigger spike in the blue line, which is secondary recovery. I'll show you that in a second. But that was a spike in 1979 when the price of silver went from $5 to $50, and people said, oh, here's my aunt's silverware. Here's my aunt's silver goblets. And you had this enormous amount. You went from a 2-week turnaround to refining scrap in early 79, mid-1979, to a 6-month turnaround to get your scrap recycled and refined back into good delivery silver by the first half of 1980. Right? So let's look at that blue line there. This is the percentage of total supply that secondary supply has. And you can see 1979 it spikes up to 50%. But for most of the time, and on average, the average since 1956, which is how far back we take our scrap projections, it was about 24.8%. It's 25%. A quarter of the newly refined silver every year on average comes from scrap. And it's been between 20 and 30% pretty much since 1984, 1985. If you only think about the mythical mining deficit, you're missing a quarter of newly refined silver. It's a good way to get your analysis wrong, but it allows you to justify being blindly bullish for bad reasons. Now, Tallulah said, oh, you're missing the systematic draining of LBMA and COMEX silver inventories going to Asia. Okay. 3 charts. On the left, you've got COMEX silver inventories. They're about 500 million ounces right now. They are at record levels. You can see that prior to 2011, 2012, they were around 100 million ounces. So that record is not 5% higher than previous levels. It's 5 times higher. There's more silver in the New York COMEX capture area in depositories in the northeastern United States that are registered with the COMEX. There's 5 times more than used to be. And that doesn't include silver at depositories that are not COMEX registered depositories. It doesn't include the silver that's stored in Florida or Nevada or Los Angeles or Idaho or other places or in people's own personal holdings. So COMEX is not being drained dry. The chart in the center is Shanghai Futures Exchange silver stocks. And you can see they're pretty high by their standards at 40 million ounces. 500 million ounces in New York, 40 million ounces in Shanghai. You can see how Shanghai has really taken over the silver market compared to New York. And you can also see how Shanghai inventories are off 60% from where they were in 2020, 5 years ago, during the COVID lockdown. Okay. And then on the right hand is London. And London's got about 750 million ounces. That's down from the 1.1 billion ounces that we saw during the COVID lockdown and the aftermath. It's down from 950 million ounces in 2016, which was when the London depositories worked with the LBMA to start reporting these numbers ever. It's more than double the 300 or more million ounces that CPM Group estimated were in London vaults in 1995. So it's still very high, and 750 compares pretty handsomely to 40 million in Shanghai. So if you believe that COMEX and the LBMA are being drained by Asian demand, you're probably going to get your investments a lot. Just maybe. And this is that $6 billion plus silver that's there. And again, you see this goes back to 1970. We actually take it back even further in our silver yearbook. Now, CPI came out for U.S. CPI for July came out this morning, and on a year-over-year basis, the headline was 0.2%. Inflation trends overall pretty much in line with where they've been since February, and where they were prior to. We had this spike up in inflationary costs in November, December, January. Basically, the interregnum period between the U.S. election and the inauguration. We saw a spike in inflation. It came back off. If you look at July, the total inflation figure was held down by lower gasoline and heating oil prices, which were down close to 10%. They were pushed higher by natural gas prices. There's been a lot of demand for natural gas, which is used to generate electricity, and we've had an extremely hot summer where air conditioning has really been at historically high levels. The demand for electricity has been at historically high levels. So natural gas prices have pushed inflation rates higher. Gasoline and heating oil prices have pushed it lower. If you look at it excluding the volatile energy and food sectors, non-food goods inflation was 1.2% in July. That's a low level. That suggests that there are no signs of tariff-induced inflation yet. These are goods manufactured in the U.S. for the most part, but also imported. Services actually rose 3.6% in July, and that was the major source, other than heating oil, for inflationary pressures. Medical services, financial services, restaurant services, right? Basically services. And we, generally speaking, don't import services. We do deport people who provide services, which causes people who are still in the country to say, I think I want a raise. But you haven't seen tariff-induced inflation in the goods. You may have seen inflation induced by other government policies in the services. And that's where we are. And if you look at it on a month-to-month basis, the blue line is the headline and includes food and energy. It's flat from June to July, but it's up from March, April, May. And the brown line is core inflation. It excludes that food and energy. And we've seen it flat March to May. And then it started rising in June, and it's risen further in July. That's the inflation story. It makes a compelling argument to be very cautious about lowering interest rates at this point. And it makes a very compelling argument to be cautious about not lowering interest rates right now. One more comment. It's a shame there's so much information out there. And we agree. It is a shame. But what's even worse is the number of people who believe and invest basis that misinformation. Some of them out of fear, some of them out of ignorance, some of them out of a deeply held faith, some of them for confirmation bias, and some of us just out of laziness. I don't want to do my homework. As one person said in a comment a few months ago, I don't read, I expect you to read, Jeff, and then tell me what you read. Well, you can read. You can go online to our website, buy our silver yearbook. It's $160. It's about 260 pages. It is definitive. All of the information I just showed you, dispelling those myths and those magical beliefs, is in that yearbook. It's an ebook. You buy it, you download it, you can start reading it, you can take it as a PDF to a copy shop and print it out. We have on the last page the print specs to print it and bind it so that it looks like this. And then you can know. Okay, and silver is $38 an ounce. Roughly speaking, you're talking about 4 ounces worth of silver. that you could spend knowing whether you should buy another 4 ounces of silver. We have a gold yearbook. Our platinum yearbook came out a couple of weeks ago at the end of July. You can download those too. You can send us a note, info@cpmgroup.com, saying, hey, I want CPM Group to help me invest more intelligently. I know you guys give us a lot of information for free on the YouTube, but I understand you've got a lot more that you supply to your paying clients. And we do. So that's all I have for today. Take care of yourself. Take care of others. Take care of those around you. Do something nice for the world. And we'll talk to you on Friday.